Hello, and we're live. Sorry for anyone who was waiting. We had a few technical issues behind the scenes that we were working on. If you're here, please say hello, just so we know that we're not speaking out into thin air. It'd be great to see who's here. And Sonia, when you're ready, give me a wave. I don't want to distract you while you're trying to sort that out.
I think I'm ready. I'm going to try sharing my screen now.
Ah, Tom, nice to see you. Mr. Fast Tracked FBA. Hi, Nick. Thanks for joining us. Sonia, have you dealt with Tom? I'm not sure.
Tom from
Fast Track FBA?
I don't think I have. I apologize if that's...
No, that's okay. Oh, sorry, I can see the messages coming in there. Yes, Tom has some US compliance, and so wasn't sure if I'd passed him over to you, but I think he might have done that before we spoke. Tom, are you in Mexico at the moment, or are you back in the UK? Smiley face. So yes, thanks for joining us. Today I'm joined by Sonia Kanji of Bridge, who is a specialist in US compliance. Sonia previously worked at another firm, which I won't necessarily mention because I don't know whether that's whether you want me to or not. But I did always recommend clients to you whenever they had US compliance issues. So we've worked with each other for a number of years. Sonia, over to you.
Thanks, Joe. Hi, everyone. Like Joe said, my name is Sonia Kanji, and I founded the firm Bridge, which is spelled BRDG, but pronounced like a bridge. And the concept is supposed to be that we can be your bridge from the UK to the US. We had slides that we put together, but the PowerPoint presentation isn't working, so I'm going to present it as a PDF. I apologize for some of the icons you're going to see on the side, but when we're done, I'll also share a copy of these PDFs with Joe to circulate to everyone, so you'll have it handy as well. And just a little bit of background on myself. As you can probably tell, I'm American. I'm technically also British. I have the UK passport because I lived in London for almost 11 years. And during that time, I worked with probably 200 to 300 businesses, helping them expand into the US, whether they were a UK limited entity selling directly to US customers, or a UK limited entity that eventually went on to set up a US subsidiary to operate locally in the market. And I'm a US CPA. My bread and butter is tax compliance, but over the years, I've also started dabbling into transfer pricing, tax advisory, cross-border planning, and any sort of state management, state advisory, and things like that. So I like to kind of bucket our focus into 3 segments. The first segment being, okay, I'm thinking about expanding into the US. What kind of planning, structuring do I need to do? Once that kind of beginning draft is formulated, then the next segment is compliance, your day-to-day filings, your day-to-day state management, and things like that. And then once your paperwork is routinely being submitted, the third segment is international and cross-border advisory. So if you guys have any questions on any of those 3 kind of focuses, feel free to pop them into the chat. Today, I'm going to kind of focus a little bit in the first segment, which is when you're thinking about expanding into the US, or you're already kind of selling there, and then the operations are getting bigger. But I'm happy to also talk about the other 2 buckets as well. Oh yeah, this is not a slideshow, so the arrow button is yeah. So I'm going to try to make this as conversational as possible. I'll start with the slide, give a few words, and then I'll pause to see if anyone wants to contribute any thoughts or comments, and then I'll also let Joe kind of moderate on behalf of his clients as well. First thing you need to know when you're entering into the US is that unlike when you enter a country in the EU, in the US, you're kind of entering a country and a sub-country. So you're going to have your laws and your obligations at the federal level. And then you're also going to have similar administration and compliance at the state level. At the federal level, it's just one type of tax, which is corporation tax. In the US, we call corporation tax income tax. And at the state level, it's state corporation tax and state sales tax. And I always like to say it's like everything is in sets of twos. There's two levels of tax. There's two ways to trigger tax. And that is either you have physical presence or you have economic presence. Physical presence is pretty easy to understand. That means that any business that has employees, an office site, or a remote work desk location, inventory in a warehouse, laptops, fixed assets, business property, any sort of business physical presence in the US automatically triggers Nexus. And Nexus is just a fancy word for taxable presence. The other way states like to capture you into their tax net is through economic presence. And this is a little bit more abstract, and it's not uniformed either. So economic presence is usually described as $500,000 of sales in a 12-month period for corporation tax purposes, or $100,000 of sales or 200 transactions in a 12-month period for sales tax purposes. I tend to work with my clients and provide them like pragmatic approaches and pragmatic advice. As e-commerce sellers, you're going to hit the 200 transactions way quicker than the $100,000 in sales. And oftentimes what that ends up meaning is that you might have a taxable presence because you have that 200 invoices you issued during the year into that state, but the total sales in that state might be $2,000, $7,000. And the cost of compliance when you hit that 200 transaction can be anywhere between $1,500 to $2,000. So if your sales are $2,000 and the cost to comply is $2,000, I usually say, look, focus on the 100K. If you get a notice, don't really spend money investing in a software or putting all this compliance in place when the sales there are they just don't justify that investment. So for our conversation, for the rest of our time together, I'm not going to focus too much on the 200 transactions. I'm going to just be pragmatic and say, keep your eye on the prize, which is generating as many sales as you can in dollars from a state. All right, I'll stop there. Joe.
Yes. So just a quick question on that. Oh, sorry, I think there's a lot of feedback from myself there. Is it my voice might be picked up on your audio? A quick question on the 200 transactions and the inventory. So a lot of our clients sell on Amazon. Do the same rules apply if you're storing inventory in FBA? And also if you had 200 transactions, because that's so tiny compared to $100,000 in sales. That's kind of quite different to 200 transactions.
Yeah. And I've spoken to clients that have spoken with Avalara and gotten a different answer to this question. So I'm going to explain it from the lens of I'm a US CPA working with my clients on making sure that they're submitting their tax filings compliantly, but also pragmatically. So what Avalara and probably what the tax codes themselves say is that if you have inventory in Amazon FBA warehouses, and I think there's anywhere between 22 to 26 of them, technically you have physical presence in those 22 to 26 warehouses because you don't know where Amazon is sending your inventory. So Avalara and the states technically say, yes, register in 26 states and do compliance in those states. Well, the way Bridge approaches this is that you don't know where that inventory is. So that's number one. Number two is if you're exclusively selling on Amazon, Amazon's already doing the sales tax compliance on your behalf because they have to do it as the marketplace facilitator. So really you're registering in 22 to 26 states only to not even have to, only to file no returns there because you're going to say all my sales are on Amazon and it's already being reported and paid for by Amazon because they're collecting the sales tax. So in my opinion, I don't think you should register with all of those states because again, the cost of compliance is super high. And if someone from the state were to say, hey, you should have filed the return and you didn't, most of those states will calculate penalties on the amount due, which is zero because Amazon's doing all the reporting for you. Or they'll say you owe us a $50 late filing fee. So again, if you were to get that notice, it's very unlucky, but it's much more manageable to just pay the state that $50 than to put all the processes in place for no filings. I just don't think it's practical.
And I don't think you're the only CPA or accountant that has said that from the US to me, because I think the way someone else put it was the cost of compliance versus the cost of non-compliance. And they kind of say, well, if the cost of compliance is more than the cost of non-compliance, kind of why would you do it, or perhaps do it later, which isn't what we would do in the UK. In the UK, it's very much like you have to do it. These are the rules. Just a quick question there. So first of all, Aisha, thank you for joining us. Yes, this will be recorded and it's going to be saved. It should be on the same link on YouTube. So if you need to come back later, feel free. And if anybody else has any questions, as Sonia mentioned at the beginning, please put them in the comments because we'll be kind of answering them as we go. And I believe Nick has left a question here, which is, what if you use a 3D print fulfillment firm? No stock is held until the part is made to order. So I think that would probably also apply, I guess, to print on demand products as well. Sonia, do you guys have any experience with that?
Yeah, actually another ECA client that is now a bridge client as well. That's how their company operates too. They print canvases, so art on canvases made to order, and they don't hold stock in the US. It's just printed by the printer and then sent directly to the client or the customer. And so in that case, you don't have any physical presence because the stock is never in your legal title held in a place for more than a day. It just immediately gets shipped out. So it's almost US manufacturer to US drop ship. So there's no physical presence there. The only thing you need to keep an eye on is the economic presence. So are you selling to customers in one state, and are you exceeding that $100,000 in that state or that $500,000 in that state for corporation tax compliance?
Thanks, Nick. Hope that answered that. Feel free to share any other questions if you have them. Yeah, those are the questions I've got there. Sonia, did you?
I think the next couple of slides, might bring more questions. So
yeah, well, actually, one more on that then. The mention of physical presence. So, employees, would that also include subcontractors, or is it genuine like payrolled employees?
So a UK limited that is using a consultant or a contractor on a limited basis, let's say part-time, they have 7 other clients, they work on your work maybe 1 day a week or a couple of days a week, that wouldn't create physical presence. But just like in the Oh, am I back?
Yes. I
Yes,
wasn't
so
sure if that
there's
was me
like
or you there, sorry.
Yeah, there's like a rule that says if it looks like a employee, acts like an employee, it's an employee. So
It's
if
a
you're
duck.
working with if you're working with a contractor, but they're working exclusively on your company 40 hours a week, full time, using your email addresses, you go on their LinkedIn profile, it's your brand, then that would be an employee. And that would create the physical presence. But yeah, as long as you're actually using a contractor in a contracting capacity, that would not.
Okay, so if someone's using Upwork or similar that wouldn't count as having a physical presence or employee.
Correct.
So we've had a few other questions. Would you like to, should we go over those first before we go forward?
Yes.
So I suppose we've got S. Brian or Burn. Can I just confirm, if Amazon FBA sell on Amazon, only Amazon doesn't pay tax and we just pay corporation tax on profit in the UK? I think what they're saying is they sell in Amazon US, only Amazon doesn't pay tax. Do they just pay corporation tax on the profit in the UK? So I guess what they're trying to ask is, at what point would they have corporation tax due in the US potentially?
Yeah. So companies that are exclusively selling on Amazon just need to make sure that those Amazon sales on a state-by-state basis don't exceed $500,000 in any particular state. So as long as you're selling on Amazon and you're selling multiple states and they're all less than $500,000, with the exception of New Jersey. New Jersey's threshold is $100K for both sales tax and corporation tax. And there's a couple other ones. But you would report all of those sales to HMRC in the UK and pay tax in the UK. But if you trip that threshold for corporation tax purposes in a particular state, then what you'll need to do is you'll need to submit a special return at the federal level, which is a nil filing, and then a state corporation tax return and pay state corporation tax. But because of that special return at the federal level, you're given certain privileges at the state level, which means you only pay a fixed minimum fee. And that fee is anywhere between $0 to $1,000, depending on the state. And that's something I'll explain a little bit more in one of the next slides.
Cool, thank you. And then one shorter question that Wallpaper Mural have sent through. They've said that they've received a letter stating that they need to file a corporate income tax return in Florida. I have an economic nexus in Florida and pay sales tax. Do I need to file a return?
Okay, so what probably happened is that you're filing sales tax returns presently in Florida, and you're collecting sales tax on your orders with ship to address in Florida. And Florida has now seen through your sales tax filings that you've probably generated more than $500,000 of sales in that state in a 12-month period, which is why they've now issued you a notice saying, hey, based on the sales you've been reporting on your sales tax return, you need to file a corporation tax return and pay tax on your profits from my state. So if the state has said that to you and you agree with what I've just summarized as my assumption of your operations in the state, then yes, you would need to file a return. And that's something Bridge can help you with.
I was just about to say, and if Dan's there in the background, are we able to quickly share the QR code for the links to Sonia's websites, just in case anybody wants to get in touch with her for any work? There we go. In the top left on my screen. Please check that. Obviously, we'll have the links below as well. But so yeah, Wallpaper Mural, if you'd like to get in touch with Sonia, feel free. And then Nick also said, so if I sell more than 100K in a month, I have to comply in a single state.
Yes. So if you're generating 100K a month from a particular state, you're definitely exceeding that sales tax threshold and corporation tax threshold. Assuming these are D2C sales or B2B sales that you're invoicing outside of Amazon, then your company would need to register for sales tax and maintain that compliance. But congratulations. Sometimes people are like, oh, shoot, I need to do this. That's like a good problem to have.
So true. Especially 100K in a single state as well. That's quite significant. Shall we move on to the next slide?
Yes. And also, I love these questions. Please keep them coming. This is probably one of the most interactive webinars.
There you go, guys. Please keep the questions coming.
So we've kind of touched on some of these points now, but here's a summary to kind of drive it all home. Is as a UK entity, what level of activity can I perform in the US before creating a taxable presence? So there's a treaty between the US and the UK that allows UK limited companies to do certain activity in the United States at the federal level without triggering a permanent establishment or a taxable presence at the federal level. One of the most commonly used ones for e-commerce brands is storing inventory with a 3PL in the US. So what the treaty says is, as long as that's all you do, so you don't have people boots on the ground, you're not continuously coming to the US to meet with people habitually. So you've got, infrequent visits to the US, and the only thing you're doing is storing that inventory. We won't tax you on the sales you make through that inventory as long as you report them to HMRC. And so that's what we call a treaty-based return or a protective filing. It actually says the word protective filing on it. And the purpose of this filing is to say, hey, IRS, I'm a UK enterprise. I meet the definitions of the treaty. I'm storing inventory at a 3PL, but all those profits are being reported to HMRC. So I'm eligible to not be double taxed on those sales. And you go officially on the record and submit that return. It's a zero return with a declaration attached to it, quoting the treaty. So that's what I was kind of alluding to in that other example, is that you may have a special filing due with the IRS. That filing is called the 1120 of protective filing. Then at the state level, yeah.
Just a quick question on that. So if you're a business that meets all of those criteria for the protective filing, do you need to file it if you haven't breached the other levels that you mentioned? So like the 100K or the 500K, like if you're just intending on trading in the US, should you file that? I suppose is my question. Or do you wait until you're sort of breaching those thresholds?
Yeah, that's a good question. I typically tell companies that if you're between $0 of sales to $100,000 of sales, don't even bother filing the protective return. There's not much to protect in that scenario. $100,000 to $500,000, you probably should file the protective return because you're already probably required to submit sales tax filing. So you're already in like the habit of doing US filing. So you might as well, what's one more filing? And especially if it's called a protective filing, right? It can't hurt you. And then when you're $500,000 plus, you definitely should be filing that because there's a lot more at stake and you want to protect those sales from double taxation.
And would that be $500,000 plus in one state, or would that be, if you were doing 90K, say, in every single state? So you'll be like, my mental math, so there'll be several million, right? But would that still apply? Or is it only if you're breaching it for like one individual state?
So for the protective filing, because it's a country level filing, I always think of it as country level sales. So if your US sales are less than $100,000, probably don't need to worry about it. If your US sales are between 100 and 500K, I suggest doing it. And then 500 plus, I strongly recommend you are doing it. Yeah.
That makes sense.
Yeah, no problem. And then at the state level, the states they don't acknowledge the treaty. So the treaty exists at the federal level, but it doesn't exist at the state level. So now, kind of going back to your question, Joe, is do I need to file the protective return if I have physical presence? Then in that scenario, yes. Even if you have less than $100,000 of sales, you have to do the protective filing and the state filing because you have physical presence. And there's a quadrant that I'm going to show in the next slide that's going to make this crystal clear, because even I'm getting confused right now by my own advice. So the key takeaway here is that at the federal level, the protective filing is good at the federal level in the sense that you get to declare all your sales to HMRC. At the state level, there's no such thing as a treaty. So you need to register with the state if you have physical presence in the state. You need to do annual corporation filings there, and you'll be subject to income tax filings and sales tax filings. But this all gets triggered if you have physical presence or economic presence in the state. So let me make it clearer on the next slide. But do you want to address are there any more questions or comments on the concepts?
There haven't been any more in the chat. Everyone who's there, now's your chance to ask a question. And I guess just so I kind of clarify that I understand it. So you've got federal income tax, which is corporation tax, and state income tax, which is a state corporation tax. Out of interest, how much is what sort of rate is the federal or state level? Because in the UK, it's just 19% and it goes up to 25%. Is it similar in the US?
At the federal level, the corporation tax rate is a flat 21%. And then at the state level, it can be anywhere between 0% to I think 11.5%. However, it's not like if you had a physical presence in California where the state corporation tax rate is 8.875%, it doesn't mean that your effective tax rate is 21 plus 8.875. What happens is, let's say you have taxable income of $100,000, and to get to that, you have revenue less expenses, and your revenue is, and I'm not great at math off the top of my head, so let's say it's $500,000. So you've got expenses of $400K, you get down to taxable income of $100K. Well, that $100K is subject to tax at the federal level at 21%. Then at the state level, of your $500,000 of sales, California is going to say, how much is from my state? So let's say it's only 100,000. So 1/5 is 20%. So then you would take your 100K, multiply it by 20%, it's 20K. From that 20K is subject to 8.875%. So you would see that your effective tax rate is going to be probably closer to like 20 to 23% instead of that 21 plus 8.875.
Wow, accounting is so much more complicated in the US.
Yeah. So there's this concept of apportionment and allocation. So a state will only tax what is legally allowed to be apportioned to their jurisdiction. Now, these are the 4 nexus scenarios, and I'm going to try to explain what I was trying to do in the last slide. Not great. I'm going to try to do it better now. So scenario 1 is, and this, you have to remember that these scenarios were all available at a much nicer capacity than when the tariff, I'm going to call them the tariff wars, before the tariff wars started. So back in the day, there was a de minimis threshold where you could drop ship orders into the US as long as it was, I think, under $800 or $850. There was no tariff on that. And so that's when scenario number 1 was very, very popular. So you had no warehouse in the US, you had no other type of physical presence in the US, and you were just at the start of your journey. So that meant you had no economic nexus either, because you're just starting off, you're less than 100K in sales in any state and no physical presence. So you had no sales tax obligations because you haven't hit the 100K in a particular state. And you definitely had no corporation tax filings either because you're not at the 500K yet. In this, I say we strongly recommend filing the protective return, but honestly, like I said, if you're in that startup phase, I don't feel good taking money from you to prepare that filing because you're still kind of getting your brand recognized. So focus on your brand, focus on building a volume of sales and a pipeline of clients, and then let's talk again. So then we would probably talk when you get to scenario 2, which is you still don't have physical presence in the US, but now you've got a solid loyalty of customers in the US, and now you're in the 100K to 500K range. And so you're probably hitting some thresholds for sales tax purposes in a state, and you're getting really close to corporation tax. So here you're probably going to have sales tax administration. I'd probably say let's start doing the protective filing, and let's also see if you need to do any state filings, because there are exceptions like New Jersey. Their threshold is 100K for both corporation tax and sales tax. So a lot of my e-commerce clients end up being having tax obligations in New Jersey before any other state. And then another state is like Michigan if you're selling there, it's $350,000 is what triggers the corporation tax filing requirement. So a little bit lower. But then if you think about Texas, California, and New York, their thresholds are much higher. So for both sales tax purposes, it's higher, and corporation tax purposes. For sales tax, it's $500,000 of sales in a 12-month period. And then for corporation tax, it's for Texas, it's $500,000. For California, it's like 700 and change, 732,000 or 780,000. And New York, it's 1.12 million. So those three states are big states because they've got lots of people. A lot of people generally tend to generate more sales from those jurisdictions, but you have a lot more leeway before you have to file there. But again, this is in the capacity of no physical presence in those states. Then you have the third scenario, which is you've established physical presence because you've got a warehouse or whatnot, but you're still less than 100K of sales in a particular state. So here, unfortunately, physical presence means automatic taxable presence. So you have to register for sales tax and corporation tax in the state that you've set up your inventory or your physical presence. And in that case, it's the only exception to the rule, which is even if you're less than 100K, you have to file the protective return because the protective return feeds into the state returns. Most state tax returns will start with federal income and then calculate taxable income in the state. So you can't really file a state return without filing a federal return. So that in that scenario, you kind of have to do the filings. So we're starting to see scenario 3 a lot more now because of the tariff wars. So companies are importing stock at a manufacturer price or manufacturer price plus a markup, storing it in a warehouse, and then selling onwards at retail price to their customers. And then finally, scenario 4 is you have both physical presence and economic presence. You're probably a more established brand. You've been selling into the US for a number of years. You're going to be registering for sales tax in multiple states, and you're probably going to be filing corporation tax in a couple of states as well. So that's when you have a full-blown compliance. And in scenario 4, it's probably if you call me and talk to me, I'm like, why haven't you set up your US entity yet? That's usually when I'm like, it's time to commit to the US.
And is there a benefit to forming a US entity in any of these scenarios?
These days, there's a lot of benefit because you can set up your US entity. Your US entity can, depending on your financing and your internal setup, but your US entity could either purchase stock from the manufacturer and bring in the stock at manufacturing price, store in a warehouse and fulfill your orders, or the US entity can purchase it from the limited at an arm's length transfer price, which is usually retail discounted up to 75%, and then bring that stock in rather than importing as a UK limited. A lot of companies sometimes have to declare at retail price, pay tariff at retail price, and then sell to the customers. Whereas with the subsidiary, you can import at a wholesale or manufacturing price, pay tariff at a much, much lower rate, and then sell onwards to your clients. So you are shifting profit margin from the UK into the US. But like I kind of explained with that California example, your effective tax rate in the US is lower. So going back to that client, the art canvas client that I had referred to who prints the art onto the pieces and drop ships to the customer, that client is very happy with shifting the margin into the US now because net there's more there's more profit in the group after tax.
Sorry, I had myself on mute there. And does that apply to all 4 scenarios, or would it only really be if you're in group 2 that you'd say it starts to be useful to consider?
There is a cost for maintaining the company and for setting up the company. So usually in year 1, if you consider the legal fees, because you probably should work with a lawyer to set up the entity or at least set up your US terms and conditions. So if you factor in those fees, I wouldn't set up the US entity unless you are keen on having physical presence in the US. If the drop shipping is still working for you, even after the tariff hikes, then you'll see why I'm saying this. I don't think it makes sense to set up the US entity. But yeah, if you work with a lawyer to set it up, you've got your 3PL fees, you've got like your accounting and tax service provider fees and setup costs and all of that. You add that all together. I usually say, hey, if you think $20,000 is too much for 1 year worth of setup and maintenance fees, you're probably not ready to set up the US entity. And then ongoing, it's probably going to be 10K per year to keep the company alive and going. So if your sales don't justify those costs, it probably doesn't make sense to set up the US entity. But if you're in scenario 4 or even scenario 2, you should, I would think you have the capacity to cover those costs. So then it probably makes sense to set it up.
That makes sense. A bit of a different question, but not maybe very slightly off topic, but one that's just popped into my head.
Yeah.
How does it actually work for US businesses? So if you're, just running a regular store, do they need to register for sales tax immediately, or do they have similar thresholds?
A brick and mortar, like a retail shop?
Yeah, I suppose any sort of store or service provider in the US, because in the UK we obviously have like the 90K turnover limit, which means you need to register. Do they have something similar, or is it sort of mandatory?
As a US domestic company, the same rules apply. So if you have a retail shop, like I have a client that's actually a UK limited company, but they set up 2 retail shops in Manhattan. They had to register immediately for sales tax because that's physical presence, and they had to charge sales tax on all the retail shop sales. But then I also have clients that are not US domestic. So all my clients are European companies expanding into the US, but they have a US domestic company and they don't have any physical presence, but the economic nexus rules still apply to that US domestic company because the rules are standardized, whether you're domestic or international.
Okay, interesting.
Any other questions from the audience?
They've all gone quiet. You've answered absolutely everything.
I thoroughly confused them. Okay, and this is our last content slide. So when should I set up the US entity? Should it be an Inc. or an LLC? What operating model should I use? What tax jurisdiction is more efficient? Do I need to consider transfer pricing? Those are like the top questions I get every week. And starting with the structuring, which entity should I set up? If you set up a US LLC, I'll be so sad because a US LLC is a great structure for a US domestic person. So if I Sonia Kanji, lived in the United States and I was going to set up an e-commerce brand, I would set it up as a US LLC because what happens is that LLC does not exist for tax purposes. It's a disregarded entity. So that means everything the LLC does is basically me. I'm doing it as the LLC single owner. And so I, as a US domestic person, already file a US tax return. So all of the LLC's activities are reported on my personal tax return. And then I pay tax at my personal level, which means I don't pay tax at the corporate level and again at my personal level. So I avoid double taxation as a US domestic person. As a UK limited that sets up a US LLC, this clearly doesn't work for you because you're not already filing a return in the US, which means you now have to file a return in the US and you now have to report all of the LLC's profits and pay tax on behalf of the LLC. So that's not an ideal situation for you to be in. It's also a much more complicated scenario in the sense that the LLC has its own obligations to file as a disregarded entity, and then the owner has obligations to file the activities of the disregarded entity, and then some cases that might even cause more filings in the UK. So an LLC is just a very complex outcome for non-US owners. You should always set up a US Inc. if you're a UK limited setting up a subsidiary in the US. And if you think about it, some of the biggest brands that have expanded into the US have always set up US Incs. And you know those guys are paying top dollars to their lawyers for that advice. So I don't know why you would do something different in comparison to those, like the industry leaders that are doing this.
Is a US Inc. the same as a C Corp?
Yes, a US Inc. and a C corporation or even a corp, they're all synonymous and it's the same thing. It's the limited equivalent in the US.
And so would that still be owned by shareholders?
Yeah, and generally the shareholder of the Inc. or the C Corp is going to be the UK company, the UK Limited.
And is the LLC more similar to a UK LLP in that it's got like a membership rather than shares, or does that still have shares? I know we're getting a bit technical, but...
No, an LLC would then, yeah. So an LLC with one owner is a disregarded entity, but it's still a member owner. And an LLC with more than one member owner is a partnership, which I think is the LLP. So yeah, it's comparable there.
And what if someone's watching this and they've set up an LLC and they're now going, oh my God, Sonia told me not to do it, and panicking? What should they do?
If you have set up an LLC, the first question I will ask you is, have you submitted your LLC filings at the federal and state level since the setup? And if the answer is no, let's talk. Let's see what's going on. As long as 3 years and 75 days have not passed from when you set up that LLC, we've got an opportunity to course correct. If more time has passed, then let's see what's been done. Let's see if we can scrap and restart, or if we need to do a voluntary disclosure to get things to be compliant. And if you've just set it up recently, so less than 75 days, we can course correct very easily.
This is why I recommend my clients to you, Sonia.
Yeah. Yeah, I had a recent person who set up an LLC. They're a software company, but they did it in 2021. And it was the first time I was stumped because I was like, okay, 3 years and 75 days have passed, so we can't use my normal course correct. But we came up with a solution because 2021, 2022 was dormant. So that's the other way we can get around some of this, is if you set it up and then forgot to use it, we can come up with a solution then too. But that was the first time in like 10 years where I had to think very hard on how to come up with a creative way to get these guys onto the good side.
We had some questions from clients ahead of this. Did you have much else to say on this final slide before I launch into those? We might have covered some of them, but they were sort of more scenario based. So
yeah, let's go with your client questions, and if we have more time to fill, then I can go on this. But this is more so just Q&A almost to help people with the slides.
Yeah, and if anybody else again has any questions, especially scenario specific to yourself, feel free. Definitely ask them while you've got access to Sonia. So the first one we had was, I run an e-commerce business as a UK limited company. We sell on Shopify, Etsy, and through Amazon FBA. If I expand to the US, what are the company tax implications, and will my business need to pay US taxes? Obviously, we sort of captured that earlier on, but if you wouldn't mind.
Oh yeah. Oh God, someone wrote it down. Okay.
Sorry.
Good.
Yeah, it was Dan will put it up.
Okay, so it's a UK limited company. Right now they're selling on Shopify, which means they have a D2C. Etsy and Amazon are marketplaces. So if I expand into the US, meaning through a US entity, let's assume, what are the
no, let's say that they don't. So if they
Okay.
just start trading into the US.
Oh, so they're selling on Shopify, Etsy, Amazon, Europe.
Yes, and then they're thinking of, let's say, doing all of the same platforms in the US.
Okay. Got it. So because you're going to have both D2C and marketplace sales, you'll probably hit those thresholds quickly. If it was just Etsy and Amazon, I would say the UK Limited goes back to those 4 scenarios. Are you selling more than 100K into the United States? Are you selling more than 100K into a particular state? And depending on the answers to those, you may have tax filings. But Etsy and Amazon are taking care of all the sales tax compliance on your behalf. It's just corporation tax filings that you have to manage. Once you bring Shopify into this, it gets tricky, because what the state says is if you exceed 100K or $500,000, right, you have either sales tax obligations or corporation tax obligations. To determine if you hit the 100K or 500K, you add together your sales from all channels. So you have to add together all your sales from Etsy through Amazon and your D2C. If the sum of all the sales into the state is more than the 100K or 500K, then yes, you will have tax implications and you'll need to file returns there. Will you need to pay tax? Likely it's going to be minimal, because at the federal level, it'll be a protective filing for the UK Limited. And then at the state level, depending on the state, it'll either be $0 to $1,000. For example, California has a minimum tax of $800. Even if you were a loss-making company and you were generating more than that $780,000 of sales from California, you file the return, you put the zeros, and then you pay that minimum $800. Everyone has to pay it. It's like a privilege tax for being able to tap into California's market.
And then the next question, thanks for that, Sonia. The next question is very similar, but it's focused on sales tax. So it's essentially, I'm trading on those platforms. Do I need to pay sales tax?
On Amazon and Shopify, no, because those on Amazon and Etsy, no, because those platforms are going to be collecting the sales tax from the customer on your behalf. On Shopify, you may need to do the same. You may need to collect sales tax on your D2C orders, and then register with the state, file the returns in the state, and remit the tax you collected on behalf of the state. And that will only come into play if your sales from Amazon, Etsy, and Shopify, when you sum those all up, is it more than $100,000 into a particular state? And then what will happen is let's say through Amazon, Etsy, and Shopify, you have $150,000 of sales. $100,000 is from the marketplaces, $50,000 is from your D2C website. On the return, you'll say, I have 150K sales in your state. 100K has been reported by marketplace facilitators. Here's the 50K that I collected and the sales tax on that 50K. Here you go.
Am I right in thinking the levels of it? Would it, like, in terms of trigger points, I suppose, does sales tax usually trigger first and then people need to worry about state and federal taxes, or is it the opposite way around with the various thresholds?
As a UK Limited, you'll never have federal tax because of the treaty, unless you hire boots on the ground, or you create more of a physical presence than what's allowed, that list of activities that was allowed. So federal taxes you shouldn't have to pay. And then for state purposes, you'll have state compliance before you ever have state tax liability.
Did you mean sales tax compliance?
Sorry. You'll have state sales tax compliance before you'll have state corporation tax liability.
Okay, so people should really first watch out for sales tax and consider doing the protective federal filing, just to sort of get rid of that. Even though they don't need to worry about it. Is that what you're saying with the federal level?
So at the federal level, there will never be any tax to pay. However, you may have to file the protective return depending on which scenario you're in. And then at the state level, you'll have state sales tax administration triggered before you have state corporation tax administration. Yeah, I think that answers the question, right? Yeah.
I was just trying to think of an easy way to summarize it later. Wallpaper Mural has asked the question, and this is a bit of a sidestep as well to the entity formations, but what's a reasonable arm's length pricing structure? Could you do cost plus 10%?
Is this for the sale of stock or a management fee?
I'm imagining, based on what we mentioned earlier, it was a transfer of inventory from the UK to the US. But if Wallpaper Mural, you're able to clarify, that would be useful. While we wait, there was another question in advance, which I quite liked. Made me laugh. It's simply, is there any way to avoid the tariffs?
Oh, I don't think so.
$1 million question.
I did speak to one brand. They sell shampoo and conditioner, and they said that they're exempt from tariffs because they have an exemption code. So I don't know, maybe if you have certain products that you're selling, because you have to use like a special code on your custom work paper. So maybe you're selling a good that's exempt from tariffs. Maybe in that capacity you are, but generally speaking, you have tariffs on most e-commerce sales. Yeah.
There's no magic wand that you can just wave to get rid of them. Wallpaper Mural, if you're able to clarify the question of what you're trying to sort your transfer pricing out for, we'll be able to quickly think about that in a second. The next question that we had in advance was regarding Wyoming. Oh, gone down. Where's it gone? Wyoming. Oh, is that Wyoming can actually be quite tax efficient? Is this true? And what are your thoughts, advice on such a strategy?
I've seen more and more Wyoming LLCs being formed. One of my clients did that as well. They are owned by a UK limited, but I told him LLC doesn't work for a UK owner. So we did a tax election to treat the Wyoming LLC as a corporation for US tax purposes. So I think the benefits in Wyoming are comparable to the benefits in Delaware for a UK company that set up a US entity, and that you don't need to file state corporation tax returns just because you've incorporated in that state. And I think
the context, Sonia, the context of this, Dan has shared, it was actually split in two. I've picked up the wrong half. So someone said, I live in the UK and want to start an e-commerce business that sells exclusively in the US. I haven't set up a company anywhere yet, but I've heard that a US LLC, specifically in states like Wyoming, can be quite tax efficient. Is this true? And what are your thoughts and advice? So I imagine you would say no to the LLC, but if they're an individual, could they think about it?
If they're an individual thinking about relocating to the US, and then setting up the Wyoming LLC, yes. But if they're an individual who's a British citizen planning to stay in England and state UK tax resident, I would not discourage the US LLC altogether. It doesn't even matter what the state is.
Okay. And nice and straightforward then. We didn't hear back from Wallpaper Mural.
Well, I will say this, that for cost plus on the sale of stock, what I've seen for a lot of brands is retail discounted anywhere between 50 to 75% as the arm's length price. And for sale stock and for management fees, the UK really likes cost plus 5%. So you figure out all the team members that are spending time on supporting the US business, you take their wages, do however many days a week that they spend on the US. So let's say 2 out of 5 times wage, mark it up by 5%, and that could be your management fee for services. But yeah, for the stock, it does vary depending on what you're selling, and people have been getting really creative. I've got the Wyoming LLC client. They are selling stock at cost, which I'm not sure how kosher that is, but they are charging a royalty on top of it. So they're like, well, the stock gets the tariff, so we're going to sell it at cost, and then we're going to charge a royalty to have the markup that we need in the UK that HMRC is going to be looking for. So that's another way that they've been doing it. So there are some creative strategies people are using to help minimize the tariff burden.
I mean, in general, I've seen 10% for the cost plus that for the most part. But I've not seen it on the US side how they feel about it.
Yeah, one way to support it, wallpaper mural, is to see if you have an existing relationship with a unrelated distributor. Like, so if you were selling stock to a third party and they were buying 10,000 units at a price that you guys have determined, you kind of use that as your starting point for the price per unit that you're going to sell 10,000 units to your related company. Because at the end of the day, the whole point of transfer pricing is that what you charge your related parties comparable to what you would charge an unrelated party, so that you're not manipulating the market between different countries. So if there's already an existing group company or a third party distributor that you are in a similar arrangement with, we use that, and then we kind of reverse engineer into it for the US.
That's really good advice. Thanks, Sonia. And then one of the final questions is, if I set up a US entity, how do I bring the accumulated profits back home to the UK? And I suppose another permutation of that would be or somewhere else.
Oh, yeah. Well, if you have accumulated profits in the US entity, you can try to pull money back into the UK through things like management fees, royalties, any sort of intercompany recharges. But let's say you've done all of that and you still have net profits in the US, you can dividend that income back to the UK Limited. Assuming that the UK Limited is held by all UK tax residents, there's nothing going on funny at the shareholder level, then the dividend would be subject to 0% withholding tax rate in the US. And my understanding is the dividend income received by the UK Limited should also be subject to 0% corporation tax, and it would only get taxed again when it's paid out to the ultimate shareholders.
Does anybody else have any other questions for Sonia while we're here? You've got off lightly today, Sonia. I thought we were going to get loads of weird and wonderful complex scenarios. The final one that we did have from our earlier questions is a bit more complicated. I'm just trying to... I can see Dan sort of split it up into two. I think because it's about 5 or 6 lines long. So I'll just see if he can finish off chopping it.
And I apologize if you can hear my dog.
Yeah.
Yeah. He's saying it's 9 o'clock. It's time, or 3 o'clock.
It's time to go for a walk. Well, we won't keep him much. We won't keep him much longer. What's his name?
Bacha. It means king in Hindi.
King. Bacha. Here's the question. I'm a UK e-commerce brand that previously dropshipped D2C orders to US customers from the UK under the de minimis threshold. Our sales to the US have dropped significantly this year because we have, drum roll, not been able to absorb the applicable import duties. Our global sales have approximately 300k, with 25% coming from US customers. At this stage, we are too early to justify setting up any US legal entities. What options do we have to legally import the goods into the US at lower value than the retail price? Oof, that was a mouthful.
Yeah. This question has been coming up a lot because this tariff war has significantly put young e-commerce brands at such a disadvantage. The brands that were previously using that de minimis, they don't have access to that, which is really unfortunate. And so I'm starting to see more and more merchant of record partners pop up. And what they're doing is they become the importer of record, and they import your stock into the US either at cost or cost plus a small markup. And then they're the ones who then go on and sell at Bergdorf and Nordstrom. And then they get at retail, and then they get the retail sales. They take a 15% commission, and then they remit the rest of the money to the brand. So that could be a possible way to at least get started in the US is to maybe use this merchant of record offering. I don't know if 15% is like a really big hit for a brand new startup, but you probably want to punch the numbers. And the thing is, because this is new, you've got these new merchant of records offering it. You give it like 6 to 8 months time, I'm sure there's going to be a next generation MOR. They're going to completely disrupt the market and have it at a lower price. So hopefully we'll see more and more of that coming up.
Oh, amazing. Thanks, Sonia. So I'm conscious that we've sort of just about to go over time. So for anybody watching that's interested in working with you or learning more about US compliance, what should they do?
You should scan that QR code and schedule a Calendly to meet with me. So I was previously based in London, and my partner, who's Kiwi, he and I moved to New Zealand in December last year, so a year ago. But I'm back in town. I'm going to be in the US for the rest of this month. I'll be in the UK from end of January till end of February. So I'll be local. If you want to meet or set up some time, contact me, and then we can put a meeting in place and then take it from there.
Amazing. Well, thanks so much for joining us, Sonia, and thank you for answering all the questions. Thank you, everyone that's also been here and thrown the questions out there. It's definitely helped. I think we'll call it a day. Thanks so much, Sonia.
Thank you so much for hosting, Joe, and I'll share these slides with your team so you can circulate to your network as well. And thanks, everyone, for your time. Merry Christmas.
Yeah, Merry Christmas. Bye.